Hi. Did you know that if you were to start investing today and continue investing and learning over the course of 10 years, you would most likely be with 70 to 80% or less than 1 in 4 people who lose money in the market? Unlike hedge funds, who even in their first year have a 50% chance of winning compared to your 70 to 80%. This topic is important to me because the market crash of 2008 and the current stock market crash has affected me and my family for the worse and have bailed out the hedge funds both times. The audience should care because they should recognize that what they're doing is not right. And if they were on the short end of their actions, they wouldn't do the things to hurt most of the working and lower class. As someone who was affected by hedge funds, not once, but twice, I have taken a great deal of research and learning the ways of how hedge funds operate and maneuver throughout the stock market. As a retail investor with a portfolio that allows me to trade like hedge funds, I feel like I'm qualified and reasonable as a liaison to communicate to you some of the aspects about this topic. First things first, hedge funds have so much capital that they can effectively put enormous amounts of money into multiple positions that might affect each other. Notice how I said hedge funds as plural, because they all effectively do the same things. Their use of leverage allows them to control more securities than if they were simply buying and selling. As a result, hedge funds' impact on the stock market has grown substantially in the last decade. According to some estimates, they control 10% of shares across the whole U.S. stock exchanges. They all use similar quantitative strategies that their computer programs can identify and reach similar conclusions about investment opportunities. They affect the market by buying the same product, like securities and commodities, at the same time and at the same price. As price rises, other programs get triggered and create buying orders for the exact same product. Furthermore, hedge funds margin their investments, trade, and risk capital. That's a very risky investment with high returns and losses. As the number of investment alternatives decreased, hedge fund managers started piling similar types of risky investments into one pot. That meant that they are more likely to either all fail together or all win together. Nervous retail investors were more likely to withdraw funds quickly at the first sign of trouble, and as a result, many hedge funds were launched and had a high level of volatility when they started out. Hedge funds are also largely unregulated. They can make investments without scrutiny from the SEC or Securities and Exchange Commission, and unlike mutual funds, they do not have to report quarterly earnings on their holdings. On the flip side, the conventional view is that hedge funds actively provide a moderating influence on the markets, but the authors challenge this idea. They infer that hedge funds are inherently conflicted in their role as liaisons because of their strong incentive to attract and retain investment capital, which is true, but they still hold too much influence on the U.S. stock exchange. In 2008, in September, a popular hedge fund, the Lehman Brothers, went bankrupt because of its investment in mortgage-backed securities. The failure of the banks caused the Dow Jones Industrial Average to plummet, and that the market alone is enough to cause economic turmoil by reducing the value of companies and their ability to raise new funds on the financial markets. The fear of further decline caused banks to refrain from loaning to each other, causing a liquidity crisis, and had a hand in the housing financial crash of 2008, which so many middle and lower class families were affected by. Lastly, I'm calling for all retail investors and the public to please take action to help pursue more regulations for hedge funds, as they have too much power and influence to manipulate markets. Thank you.